Hello and welcome, guys. Today we are going to take a look at a brand new ETF with the ticker symbol QQQY. As you can see, it's a Nasdaq 100 option income ETF. And the great thing about this one is that it is targeting a distribution yield of 67.5%. That's right, an annual distribution yield of 67%. So, this, in terms of its distribution, is again very insane and very similar to some of the yield max ETFs. But unlike the yield max ETFs, this one uses a very different strategy to generate this income. So they are using a put right strategy instead of covered call. Now, put right is very similar to covered call. They are, you can think of them as inverse of each other. So in a covered call, you purchase 100 shares of a stock, then sell a call for a strike price. If the price of the shares hits that strike price or goes above that strike price, you still have to sell those 100 shares at that strike. With put options, you sell the option for a strike price, collect the premium, and if the price of the stock remains above the strike price, then the option expires worthless. But if the price of the stock goes below your strike price, in this case, you still have to purchase those shares at that strike price. So it's very similar to covered call, just an inverse version. In case of covered call, you have to have the shares of the underlying stock as the collateral. In case of put right, you need to have cash as a collateral. So the interesting bit is not just that they are using a put right strategy. What they're actually doing also is they're using 0 days to expiry. So basically, they are going to write an option every day. Every trading day, they're going to write an option at the end of the day, and then they will close the option the next day. And then again, the next day, they'll write a new option and then close it the following trading day. So this they will do the entire month. And based on that, they are hoping to generate far more income than what is possible for some other ETFs that just sell one option every month. Now let's take a look at its distributions. As we already know, this is a very new ETF and they only have one distribution so far. And in fact, it was paid out very recently on the 5th of October for $1.10. And if we actually do some maths on that one, so let's do a quick calculation. $1.10 into 12. And if we divide it by its current price of $18.53, and then we actually get a distribution rate of 71%. So that's actually better than what they are showing on their website. But for the time being, we'll just go with the 67% because the monthly distributions can change. Now, the other thing I do want to highlight is the fact that how are they able to generate such high yields? I mean, we know they're using the put right strategy and sort of writing a daily option, which helps them to capitalize on the decay of the option. So their real strategy is to really sort of capitalize on the option decay. And the shorter the duration of the option is, the faster the decay happens, which is the time decay that we are talking about here. And if we want to just get into more numbers, we have this paragraph on the prospectus, which mentioned that the fund seeks to make monthly distributions. To enable to do so, the fund seeks to generate a consistent stream of income. But the important line that I want you to look at is this one: minimum daily income of 0.25%. So every trading day, they are targeting an income of 0.25% on the options that they're writing. So if we do the math on that one again, so let's go back to the calculator. So on average, there are around 22 trading days in a month, multiplied by 12. So that's 264 trading days in a year. And if you multiply it by 0.25, so that's how we get the 66% for the whole year. So here are my final thoughts on this ETF. For starters, this is a very new ETF, hence we do not have enough data to really comment on its effectiveness. We do not know whether there is going to be too much of a NAV erosion, which is generally a common feature with a lot of these options income strategies. And also, we do not know how reliable their distributions are going to be because they only have 1 month distribution released so far. Having said that, the strategy that this ETF is using, to me, it actually seems to be better than the yield max strategy. And I'll give you the reason why. Remember, the underlying holding for this ETF is the Nasdaq index, as opposed to the yield max ETFs, which are using a single stock in each of their ETFs. So clearly, the Nasdaq index as a whole is actually less volatile compared to, say, the shares of Tesla or Nvidia, which are just single stocks. And yet, this ETF is generating a yield, or at least aiming to generate a yield, which is almost on par with what yield max is generating with single stocks. So, with lower volatility, this ETF using this put right strategy is able to generate a higher yield, or will be able to generate a higher yield, assuming they are able to execute what they have planned. And if this works out, say within the next 12 months, they are actually able to give you a 67% distribution overall for the whole year. I would love to see them use the same strategy on a single stock, because if they're able to generate a high income of 67% using the volatility of an index, I think if these guys were to use a single stock, they would generate a much higher yield. Maybe, I don't know, we might shoot past 100% if they were to hold a single stock and use this put right 0 days to expiry strategy. Last but not the least, this ETF is managed by the same guy who manages the yield max ETFs, the person you see on the screen right now, Jay Pestricelli. So, as far as the management is concerned, there is pretty much no real difference between the yield max ETFs and the QQQY ETF. They are managed by the same person. I would like to finish this video by showing a very simple calculation that highlights how insane this yield is. Now, the average income in the US is around $40,000 for the whole year. Now, if you were to invest $60,000 in this ETF and you do end up receiving 67% every year, then over the year you would actually end up receiving the same amount as an average American earns in a given year, which is insane. And the funny thing is, if they are actually able to replicate this yield for the foreseeable future, you could basically retire from just $60,000. It feels too good to be true, and I don't know, probably it is. So I would say if you are planning to invest in this, do it slowly and maybe keep a watch on how this ETF is actually performing. It's again very new. So, as always, make sure to do your own due diligence before making any investment choice. And thanks for watching, guys. If you found this video useful, don't forget to like, share, and subscribe. See you in the next one.